Wu, and I am a co-director of the CSEP Center at School of Accounting and Finance at Hong Kong PolyU. As you might know, CSEP is the first research and educational center in Hong Kong dedicated to promote research, education, and knowledge transfer with our industrial partners. With the support of the Hong Kong government, CSEP is organizing a series of the seminars called PASS seminars. Today is the 8th seminar, and the topic is trends and opportunities for green and sustainability linked loans, a bank perspective. We are so delighted to have 3 outstanding speakers, both from academic and from financial industries, to give them their insights and thoughts on this topic. Just to remind you before we start, if you have any questions for our speakers, please type in the chat room. So we will ask a speaker to answer your questions at the end of the speech, okay? Without further ado, I would like to introduce our first speaker, Professor Tong Wang. Professor Wang is an assistant professor at Hong Kong PolyU. His research interests include banking, accounting quality, and climate change risk. Dr. Wang is one of the most productive faculties at Hong Kong PolyU. I would say the most productive one. And he has published a lot of top journals in our field, including the Accounting Review, Review of Accounting Studies, JFQA, Journal of International Business Studies, Organizational Science, and Journal of Business Ethics. He is really a rising star in our field. Dr. Wang holds 2 PhD degrees, a PhD in accounting from Xiamen University, and another PhD in accounting from University of Kentucky. Very impressive. So next, we welcome Dr. Wang to give his research update about climate risk and banking finance. So the floor is yours, Dr. Wang.
Thank you, Professor Wu's very warm and kind introduction. So I'm very glad to share my recent working paper about a related topic. Can you see my screen? All right, so I will continue. So the topic I'm going to share today is about bank lending in a warming globe, carbon emission and loan contracting. Clearly, this is a joint work with 2 other professors, Professor Kim from CTU and Professor Wu from Lingnan University. So here is my presentation framework. First, I will talk about my research question. As the title shows, my research question is very straightforward and easy. So in this paper, we would like to investigate how borrowers' carbon emission will affect the bank loan contracting terms. And more specifically, in this paper, we are going to use 2 measures, Scope 1 carbon emission and Scope 2 carbon emission, to capture the level of carbon emission of borrowers. And more specifically, we are going to use 3 bank loan terms to capture the bank loan contracting, such as loan spread, collateral, and covenants intensity. A more background information why we study carbon emission. So on average, we believe climate change will cost a global economy about 1% to 3% reduction in GDP. This is from OECD 2015's estimation. So clearly this will be a very large number, a significant number. And according to the World Economic Forum, in terms of likelihood and impact, climate change would be one of the top 5 global risks the world currently facing. And clearly, the carbon emission is a main contributor of climate change. And actually, carbon emission has already invoked a lot of attentions and concerns and widespread cooperations throughout the world, such as 1902 UNFCCC, 1907 Kyoto Protocol, and most recently, 2015 Paris Agreement. And why we started bank loan contracting? So first of all, banks facilitate and provide almost the majority or significant amount of the capital, such as over 95% of new external capital is from debt financing. At the same time, we believe loan contracting is covers a lot of different perspectives, including some pricing terms and non-pricing terms. Pricing terms such as spread, non-pricing terms such as maturity, loan size, collateral, and so on. So we believe loan contracting can give us more richer information and can give banks some flexibility in lending decision. It would benefit us to investigate the relationship between carbon emission and loan decision. Another reason we are focusing on bank loan contracting is because actually the financial sector is one of the first group to establish the management, the climate change management framework to target on carbon emission reduction. For example, Citibank, Morgan Chase, and Morgan Stanley, those very large bank and investment banks form a so-called carbon principle, which is a kind of very loose organization, but call for enhanced diligence in evaluating elective power industry borrowers in terms of their use of energy efficiency or low carbon energy technologies. Essentially, they establish this carbon principle to kind of promote the carbon emission reduction. All right, a very quick review on what the current academic research is doing. So more current academic research is investigate the carbon emission and the firm value. In other words, from stockholders' perspective. So they already find that, all right, so carbon emission is negatively correlated with firm value. It's from stockholders' perspective, stockholders believe carbon emission is a bad thing. However, we haven't have enough evidence on how banks or how creditors price borrowers' carbon emission. Okay, and another motivation from academic research is we currently have many papers or research on how banks price borrowers' toxic chemicals emission or borrowers' CSR or ESG activities. However, we haven't seen much research on how banks price borrowers' carbon emission, especially by using some quantity data. And we utilize one database which provide us very detailed carbon emission data, can enable us to provide more clear-cut indications about how banks to price borrowers' carbon emission. Okay, so now we are coming to our hypothesis. Hypothesis, which is a kind of term we use a lot in academic research. We argue that you can consider hypothesis like the rationale or underlying story of this paper. So we argue that borrowers with a higher or larger carbon emission are more likely to receive additional or unpredicted regulations, and potentially with more compliance cost and higher litigation cost and pollution mediation expense, which will lead higher operational cost or lower profitability. Clearly, this eventually will increase credit risk in the bank loan contracting. So from lenders' perspective, lenders can be also legally liable for some environmental damage caused by the projects they finance, especially in US. The lending money to the borrower with very high level carbon emissions might be also very risky to the lenders. That's why we come up with our first guess or first story. So we argue that borrowers with higher or larger carbon emission might have more unfavorable bank loan contracting terms, such as higher spread, or more likely be required to provide collateral and so on. So we get carbon emission, detailed carbon emission data from CDP, from Carbon Disclosure Project. CDP, which is a London-based non-profit, non-governmental organization that represents more than 650 institutional investors with 87 trillion in assets under management. So it's a very very large organization. And for every year, CDP will ask the top executive managers to disclose some related climate change risk, also firm level carbon emission data. This data is widely used in our academic research. So in our paper, we are using two levels carbon emission. According to GHG protocol, we are focusing on both carbon emission. One is scope one, which is a direct carbon emission. Scope 2, which is a indirect carbon emission. For bank loan contracting, so we are using both price term and non-price term. So price terms such as loan spread, non-pricing term like the collateral requirement or number of covenants. Our sample covers the year 07 to 14, which covers 8 years bank loan globally. Bank loan globally. And we get the bank loan data from DealScan, which is a very widely used in academic research. And we control many firm characteristics and even country characteristics. In our final sample, we cover more than 3,600 bank loan facilities and from 33 countries or regions, from including developing countries and developed countries. All right, so here are some our main results. So overall, we find that if the company have a higher carbon emissions, we find the firms are more likely to have unfavorable bank loan terms, such as higher spread, or more likely be required to provide collateral or have higher covenant restrictions. And the economic significance is also potentially large. We find one standard deviation increase in carbon emission will lead 17 basis point increase in loan spread and 10% higher in likelihood of being requested as collateral, providing a collateral. and 0.02 more number of covenants. In the next step, we are trying to split the total carbon emission into scope 1 and scope 2. Please recall scope 1 means direct emission. Okay, scope 2 means indirect emission. So overall, we find that, all right, so banks penalized only borrowers' scope 1's emission, instead of scope 2. Okay, because our explanation is because scope 1's carbon emission is more related to the potential regulation and are more likely to incur some additional cost for the borrowers. And we also conduct a whole bunch of different robustness checks. And in our next part, we are trying to investigate. Now we have already known that okay, banks do not like borrowers' carbon emission. So we would like to investigate, okay, this relationship is stronger or strengthened or weakened under which condition. So in the first condition we want to test is whether the borrower has any carbon reduction plan. We find that if borrower has the carbon emission reduction plan, so we find, okay, banks are more relieved. So in other words, banks are kind of tend to put lower the stringency of the loan term by making the loan cheaper or imposing fewer restrictive covenants to the borrower if the borrower have some carbon reduction plans. In the second part, we examine whether borrower has any carbon governance. So how do we measure carbon governance? We are using three aspects. The first is whether the ranks of the manager in charge of the climate change issue, such as whether the board of director is charging the climate change issue or only a department manager are charging. So the higher the rank, they have a better carbon governance. The second aspect is whether the company has a specific climate change management arrangement or measures. The last angle is whether the company incorporate climate change into their business strategy. So overall, we consider those three measures as to proxy the carbon governance. We find overall, if the borrower has better carbon governance, okay, the relationship between carbon emission and bank loan contracting terms will be weakened. In the last interaction term, we investigate how extreme weather or extreme climate play a role in the relationship between carbon emission and bank loan. So we find that in the countries that experience more extreme climate, in those countries, the relationship between carbon emission and the loan spread is more pronounced, meaning that in the more extreme climate countries, the banks seem to punish the high carbon emission borrowers even harder or even more. In the next part, we also perform a few channel tests. So in our story, or in our hypothesis, we argue that, okay, borrowers with higher carbon emission are more likely to have some additional cost, or eventually will harm companies, borrowers' profitability or operational efficiency. Now we are going to test that. So we find that, okay, borrowers with higher carbon emission are more likely to receive the regulatory scrutiny from the environmental regulator, and their profitability is lower and have a higher bankruptcy risk. In the next part, we want to test whether banks can kind of play some rules in limiting or in restricting borrowers' carbon emission. So we so-called whether due to the bank loan contracting terms, whether the borrowers can change their own behaviors. So now we have that, we could find that, all right, so if the borrower has received more strict loan terms, and those borrowers are more likely to introduce future carbon reduction plans. So it means, okay, if banks can push the borrower harder or put higher pressure on borrowers with larger carbon emissions through tightening the loan contracting terms, so the borrower actually will consider lower their carbon emission in the future. Okay, try to obtain more favorable loan terms in the future if they have any loan deals with banks. All right, so come to our conclusion. So essentially, our paper investigates the relationship between borrower's carbon emission and the bank loan contracting terms. So we find that overall, carbon emission leads to more unfavorable loan contracting terms. And we find this unfavorable results is driven by scope 1 carbon emission or direct carbon emission instead of indirect carbon emission. And we also perform a few condition tests to test under which condition this relationship is stronger or weaker. So we find this relationship is weaker when the borrower has a carbon emission reduction plan, and when company has stronger carbon governance. And this relationship is stronger when the borrower's countries with a more extreme climate. And we also perform some channel tests. We find carbon emission is positively related with regulatory risk and negatively related with borrower's profitability and positively related with bankruptcy likelihood. And our real effects results show actually bank can play a very active role to lead the borrower to involve more carbon emission reduction activities. Thank you so much for your listening, and looking forward to your comments at the end of the seminar.
Thank you, Dr. Wang. Thank you so much to sharing your research outcome with us. It's a very timely and important topic. I think your analysis is very thorough and well done. Congratulations. Next, we are going to invite our second speaker to give us our thoughts. Our second speaker is Angela Wang. Angela Wang currently is the head of risk analytics in DBS Bank Hong Kong Limited. Angela manages both wholesale and retail risk modeling, maintenance, regulatory communication, stress test, and risk appetite framework. She also leads DBS efforts in the participation of the HKMA pilot climate risk stress test exercise in 2021. Prior to DBS, Angela had risk management experience in Credit Suisse and HSBC, covered wealth management, consumer and wholesale credit risk. Angela is a chartered accountant and graduate master in economics. She is also certified in sustainability and climate risk from Global Association of Risk Professionals last year. Climate risk management is one of her favorite topics to promote the awareness and education in community and professional bodies. Let's welcome Angela to give her insights.
Thank you. Thank you, Professor Wu. Um, to further on what Professor Wang said, yes, banks do play an important role in helping the climate change. Thank you. Thank you for the opportunity to speak in this seminar. I manage the risk analytics team in Hong Kong, DBS Hong Kong Risk Management Group. So today I'm going to share with you from a bank perspective what climate risk management is and some high-level overview of how do we intend to manage this. Okay, so before I go on, I just would like to clear a concept. That is, when we are talking about climate risk, so we are talking about two lands from the similar thing. On the left-hand side, imagine that you are standing at the toes of a bank. So you have a portfolio of customers whereby they have different level of carbon emissions if they disclose. Then the analytics or the risk manager needs to do is to understand the impact, that means the dollar amount impact, the financial risk arising from climate change may bring to the creditworthiness of our borrowers. So like what Dr. Wang said, maybe in extreme, in places where with extreme weather, the potential cost to the customers may increase if there is some acute climate weather events, or if the regulation changes that start to impose carbon tax that increase the cost burden of the borrowers. So on the left-hand side is on the risk management part. But bear in mind, when we say risk management, it does not necessarily equal to greening the portfolio yet. So, and then on the right-hand side, the right-hand bubble is that now, after we understand how climate changes could potentially affect the creditworthiness of customers, usually we'll use the form of scenario analysis to find out. Then we are in a better vision, although I cannot say we have a crystal ball, but we have a better sense about what's likely to happen to our customers if certain scenario plays out. So, and then it will start our discussions with the customers, trying to understand and help them to explore possibilities in reducing their carbon emissions intensity, in moving towards our common goal of net zero by a certain time. So then it comes in the right-hand side, is at the portfolio level, what kind of risk appetite that we can set to steer the whole portfolio towards greening. And at a client level, the discussions and client engagement that each bank, a lot of banks are actively pursuing to try to support the portfolio to move towards the net zero target. And one thing to note is that portfolio greening, it does not necessarily equal to less risk. Okay, so let's say we have a manufacturer of solar panels. Just by doing this business does not necessarily mean that this solar panel company is of less or more credit risk. So it still boils down to the other dimensions of risk analysis, like the financials, the management quality, etc., etc. So these two sides of the lens are side by side. So my presentation will more focus on the left-hand side from risk management perspective. And then in the next presentation, we'll have our fellows from Hang Seng Bank to cover more on the business side of the opportunities of green lending. Okay, so especially for attendees who are interested in risk management, find a job here in this area, or yeah, so I think you find the right topic here. So now this slide I try to show is that on a high level perspective, when we say a climate risk, what is this? So is it a different type of risk type other than the traditional credit, market, and operational risk that we usually talk about? In general, no. What my thinking or our thinking is that climate risk actually can show up itself along the traditional risk types. For example, my focus on this presentation will be more on credit risk. The reason being that is one of the most prominent and most material risk that usually commercial banks and consumer banks would look at. There are two possible channels that the climate change impact could realize in credit risk. So I'll focus a little bit more later on. One is transition. We call transition risk, meaning that the risk of a borrower when they transit to a low carbon economy, the type of let's say technology development, the change in consumer preference, and even if there is an introduction of regulatory changes, these types of shocks, how they are going to affect whether the customer can smoothly transition to the new economy. And the second transmission channel is physical risk. Physical risk means that under the acute weather events like flooding or heavy rainstorms, earthquakes, tsunami, all those natural disasters, and also some gradual chronic change in climate like the rise in sea level. So how these climate events could bring the financial and unfavorable impact to companies. So these are the two transmission channels. So on the left-hand side, strategic risk means that given the potential impacts to the bank, how is it going to affect the way that we achieved our strategic goals? For example, keeping at a certain earnings and profitability levels, keeping a certain external rating, and also capital adequacy and or the business focus, etc. On the middle box, market risk. So the impact of climate events can come in the form of, for example, for a certain carbon intensive companies or certain carbon intensive sectors like oil and gas, energy productions, etc. There could be volatility and impact to their company valuations if the impact of climate risk is unpriced into their valuation. Because one thing we need to note at is that whenever we talk about climate risk, the horizon that we are talking about is talking about the next 20, 30 years time. So whatever model or whatever scenario analysis that we use, the techniques that we use, there are still quite high level of uncertainty within 20, 30 years of time. So there it comes the possibility of the risk being unpriced in the current market. The next box, reputational risk, just like the previous presentation sharing, in case a company is facing a huge, let's say, a legal reputation litigation as a result of, for example, like burning the forest, damaging the environments, or even polluting the ocean because of some oil splittage, for example, then those are the possible scenarios whereby companies might be subject to reputational risk as well as a result of climate. Liquidity, like the ability for banks to raise funding as a result of our reputation or as a result of the efforts as perceived or as required by investors on contributing to the overall climate and net zero agenda. And lastly, but not least, operational risk. Let's imagine if one day, in 30 years' time, if the sea level of Hong Kong increases by about like 5 meters, then a lot of like places near the shore, for example, Central, or even some of the West Kowloon areas could be subject to this flooding risk that would affect the business operations, and it may even affect the properties owned by the companies. So that explains why we've believed that instead of putting climate risk as its own box, actually this risk would show up itself in all the different risk types that we manage on a day-to-day basis. And if you aspire to develop your career in risk management, then climate is really an area that I would really recommend you to learn and pick up the knowledge, because the job market is very hot on this. Okay, so let's zoom in a little bit deeper on transition risk and physical risk that focus on credit, the unfavorable credit impact, credit risk impact as a result of climate. Let's start on transition risk on the left-hand side. So on the left-hand side, when we say transition pathways, okay, you may ignore all those terminologies of what is integrated assessment models and things like that. So these are the models, the global climate models developed by a lot of internationally credible organizations, NGFS being one of them. NGFS stands for Network for Greening Financial Systems. They have a team of expertise scientists behind that develop these global macroeconomic models that try to project the likely pathways meaning that from now until 2050, what are the possible scenarios that we can achieve to net zero, be it a very smooth transition or be it a very bumpy road, or will the policy actions come late? And then what are the economical impacts? What are the potential policy changes? And also, let's say the carbon price, carbon tax, technological advancements, like how advanced can we do carbon capture and removal technology, how the consumer preferences would change over time. For example, whether customers would change, how fast it will change to use electronic vehicles instead of vehicles making use of fossil fuels. So these are the very complex global demand and supply models that are developed by NGFS. And then we make use, actually a lot of banks, including ourselves, including my bank, we reference to these internationally available scenarios and their outputs that already tell us the possible scenarios on, for example, the change in GDP, the demand and supply on electricity and fossil fuels, and also the change in energy consumption over time from now until 2050. Then what we do is we based on these scenarios to model the impact to the financial strength of the companies on the left-hand side of this slide. For example, under the specific scenario, then what would be the impact to, let's say, an oil and gas drilling company? Let's say if their scope 1 emissions is quite high, because along the operations, they will actually produce quite a lot of carbon emissions, and therefore, under a specific scenario, the impact, the cost of paying the carbon tax could increase a lot. If, let's say, the carbon tax increased by a substantial amount in the future, then their operating costs may increase, their profit margin could be squeezed, and therefore affecting their profitability performance. And as a result, in order for these companies to transition to a low carbon economy, they need to invest in capital expenditure to transform, right? So it also affects their balance sheet and also their debt burden capability. So it's a very complex and dynamic assessment, bottom-up approach, meaning that depending on the carbon emissions of each individual borrowers, the potential impact as a result of transition could be different. And then on the right-hand side, physical risk. Physical risk is the other dimensions of the potential impact. So as what I briefly mentioned, we would categorize the source of physical risk from both chronic climate change. Like take example of Hong Kong is talking about our sea level rise, as we are quite close to like the coastal areas and the Delta Bay area. When the carbon emissions continue to increase, then the surface temperature may increase. That would have some chronic impact to, for example, as a consumer preference, maybe in the future, we would buy less of a winter clothes and more of summer clothes. We'll change the preference in a way, for example, even the choice of living place. Would we still choose to live near the sea? That then in the future, in 10, 20 years time, there might be some impact as a result of the physical risk. And also, if there are some very acute weather events, what we call the natural catastrophe models, these are again some global science models produced from NGFS as well. So the prediction on the flooding and strong typhoons, as strong as, for example, we came across Mangkhut in a recent few years. What if the same level of magnitude as Typhoon Mangkhut will hit Hong Kong more frequently in the future? Then what will be the impact to the properties as a collateral value? What would be the impact to the businesses? Let's say the retail shops would need to close. Shops near the ground floor could be more affected. So these are the possible risks that we model for physical risk. And then one thing I want to highlight is that when we talk about transition and physical risk, so these 4 boxes represents the different permutations that the scientists are trying to project the different scenarios. And this scenario analysis is one of the very commonly used tools nowadays to assess the potential impacts, including our dear regulator, HKMA, and also my home regulator, MAS, and also even in the outside of Asia, in Europe, like the PRA and the European Commission, there are a lot of currently ongoing climate-related scenario analysis work being done. And so when we say these climate scenario analysis, so we try to project the impact based on some specific scenarios. Because remember, we are talking about 30 years from now. So, and then some of the impacts like extreme weather or the carbon transition, these are unseen. I mean, we cannot observe from our historical data. So therefore, scenario analysis is one of the tools that commonly used in the risk management space. I want to introduce these 4 different types of scenarios. You may note that when we say, okay, the vertical side, transition risk, under the top box, when we say disorderly, is a disorderly scenario. That means disorderly transition, meaning that the introduction of the carbon tax or regulatory changes is slightly delayed to around 2030. And then therefore, the pace of transiting to a low carbon economy needs to be faster by then. because we are kind of running out the remaining quota that the Earth is able to support. So therefore, the yellow boxes, this orderly scenario would represent the scenario that the transition risk is higher. But orderly transition means that from now until 2050, we can orderly transit the economy, meaning that we can smoothly, gradually, and in a good pace, fast enough pace to transit. So the unfavorable impact to borrower could be reduced. But bear in mind when we say when transition risk is high, why the physical risk is low? Because these two things are actually hand in hand. When we work really hard to transition to a low carbon economy, then as a result, the carbon emissions could be reduced faster. Then what it means is that the temperature increase could be more controlled at below 2 degrees Celsius worldwide. And as a result, then the physical risk, that means the risk from extreme weather events, could be reduced. So therefore, you can see that these two dimensions, they actually go in they go in a different directions. If transition risk is high, then physical risk is usually low. But what if physical risk is high, meaning that the hot house world, or too little too late, meaning that the actions, the policy actions are delayed, or no policy actions, or minimal technology change, then the temperature will be increasing quite fast to an extent that would introduce a lot of extreme weather events that would introduce high physical risk. So in total, there are many scenarios here when we conduct the what we call a climate risk stress test. Okay, so I want to briefly mention about what it means by the different scenarios. So I extracted this chart from NGFS again. So when I say disorderly, so on the top left-hand side, disorderly transition, it means that this line chart, you can see that we are now standing at 2020, assuming. So the dotted line is our historical CO2 emissions for illustration, global-wise. And then the blue lines are the projections under different scenarios. Under the disorderly scenarios, assuming that you can see that the carbon emissions would only start to drop at around 2030. The reason being that the strong policy actions would be only introduced by them under this scenario. Then we say the policy reactions delayed. Technology change is slow at the beginning and need to fast change at the later part. CDR means the carbon removal. The carbon dioxide removal technology is slow. And then there is also a high variation in the regional policy actions and the strength of the action. And as a result, the curve at the later part of the 2040 and 50 needs to be very steep to catch up the net zero commitment. And then the most a more optimistic scenario is the orderly scenario, whereby we say that we start action from now, and therefore the transition can be smoother, can be more smooth, and therefore the temperature can be controlled within 2 degrees Celsius, and we can achieve the net zero target by 2060 here in the line. And then the most pessimistic scenario, whereby I hope not to see it 30 years down the road. If it happens, then probably I will cry a lot. Then this hothouse world, under assuming a policy to be very minimal, assume the policies to remain as current, and therefore the temperature increase will increase more than 3 degrees compared with now. And as a result, the physical risk will increase. So I hope it gives you a flavor about the two key transmission channels of transition risk and physical risk from a risk management perspective. And then I also want to give you a flavor about when we say reaching net zero by 2050. Based on these scenarios, what are the changes in the economy that we need to see in order to move towards our net zero target? So these bar charts I sourced it from NGFS, is again based on their global climate models. On the upper left-hand side, a transition to 2050 means that the usage of renewables, renewable energies, that means the blue part need to increase significantly. So the wind, solar, and hydro, the electricity. The brown color area represents those fossil fuels related energy source. They need to be phased out, like the light orange color, the bottom one, that represents fossil fuels as well, the coal. So based on this scientific projection, the science projection, we need to phase out the coal and also significantly increase the renewables energy consumptions by 2050. And then on the right-hand side, it also means that the mode of transportation and industrial processes, for example, cement building, chemicals productions, and even the heating for buildings, these all need to move towards the use of electric or even other alternative low carbon energy source. So the last chart on the bottom, this represents that we will need to see more than like 40%. That means the blue part of these fuels, gas, liquid, and solid fuels. We need to have new technology to make them to be carbon neutral. So you may have heard that there is a more investments and scientific research on the use of hydrogen for car as a car fuels, green hydrogen, not brown hydrogen, and also biomass and bioliquids to replace fossil fuels. So these are all the drastic changes. We will see risk because change is usually not easy, but it takes a lot of effort to change. And then it also presents opportunities for you if you are looking for career development in this area, and also for you if you are a banker, if you're banks that look for the business opportunities. So then I will pass my time back to Dr. Wu. Maybe then we can talk about the next on the opportunities side from a business perspective.
Thank you so much. Thank you so much for sharing your insights from the risk management perspective of how to control the climate risk. It's very, very informative. Thank you. So our third speaker will be Frank Sean, and he will give us remark on the opportunity of green finance. So Frank is a seasoned commercial banker with over 30 years experience in different local and foreign financial institutions. Graduated from University of Hong Kong, Frank has started his career as relationship manager of corporates from different sectors, including manufacturing, retail, construction, property development, and investment. In 2006, Frank has joined Hang Seng Bank and later took the management job as a commercial bank as a leader of commercial bank division. Frank is now working as a head of structured finance commercial real estate and corporate advisory with 2 product teams and 1 relationship team in Taiwan under management. In 2020, he has established Green Loan Team in Hang Seng Bank to promote green financing and originate both bilateral and syndicated green transactions. He is also Hang Seng Bank's representative in Hong Kong Green Finance Association and the Asia Pacific Loan Market Association. Frank, the floor is yours. Thank you.
Yes. Okay. In view of the destructive impacts of climate change, governments have also started to devote more effort into tackling climate change. For example, tackling the target set by Chinese government, which pledged to reach peak carbon emissions before 2030 and achieve carbon neutrality by 2060. The Hong Kong government has also announced its Climate Action Plan 2050 in October 2021 that clearly sets out the target and roadmap of achieving carbon neutrality before 2050. In response to the government's increasing concerns over ESG-related issues, the financial sector is strongly encouraged to put more effort on sustainability as well. For instance, the white paper on green and sustainable banking, which outlines Hong Kong MA's initial views on the supervisory expectations for authorized institutions in addressing climate-related issues. With the rising involvement of governments, as well as the worsening threats of climate change, it is noted that sustainable financing is becoming more prevalent in the global context. For example, when we take a closer look at the statistics on the right-hand side, we can see that global green and sustainable debt issuance rose drastically from 2013 to 2020. Apart from illustrating global concerns over climate change, the statistics also implies the market's increasing demand for new and innovative green products. Taking sustainability-linked loans, SLL, as an example, the first version of the SLL principle was only launched in 2019, but we can see that the issuance volume has increased significantly over the past few years. By the way, Hang Seng Bank has also launched the SLL products to our customers last year to capture this growing trend, in which I will discuss in detail later. I believe that Hong Kong as an international financial center with a sound world-class regulatory framework and a well-established ecosystem, we can serve as a premier platform for green and sustainable financing, not just for our clients or projects in Hong Kong, but to all companies around the world. According to the Hong Kong MA, the total volume of green bond and loans issued in Hong Kong in 2021 reached $12 billion, which was triple the amount in 2017, and 1/3 of them was first-time issuers in Hong Kong. With sustainable finance becoming a rising global trend, more and more green products are introduced in recent years. And in my presentation today, we will be focusing on 2 of the most popular products in the financing market, green loan and sustainability-linked loan. Before moving on to introducing these 2 products, allow me to take this opportunity to share our achievement in 2021 with you. As the growth of our bank's green and sustainability financing has been remarkable, and I'm excited to see that my team has already built a strong pipeline to start the year. With the aspiration to become a leading entity to drive ESG in the banking industry, Hang Seng Bank has been actively stepping up this consideration and inclusion of ESG issues with respect to our products, services, and operations. We are highly aware of the need to broaden the variety of its offerings and in particular, focus on that of sustainable finance that addresses one out of many major and urgent challenges of climate change. Therefore, we established our green and sustainable finance team in 2020 and have been very active since establishment. In 2021, we have approved Hong Kong dollar 7.3 billion green loans, which was 40 times of that in 2020. With our continuous dedication in driving ESG in the banking industry, Hang Seng Bank is proud to have been recognized by the market for our efforts in encountering climate change. In addition to the MOU signed with the Hong Kong Quality Assurance Agency in August 2021, we are proud to receive the Outstanding Award for Green and Sustainable Loan Structuring Advisor, Greater Bay Area Corporate, from the HKQAA in December 2021. In view of Hang Seng Bank's dedication to expand its sustainability portfolio, some of you might be curious about our product offerings and how they work. Currently, our green team offers mainly two green products, green loan and sustainability linked loans. In the following slides, I will give you a quick introduction of these two products. Let's start with the green loan. In simple terms, a green loan is any types of loan instrument made available exclusively to finance or refinance in whole or in part dedicated green projects. To qualify, a loan must adhere to criteria on the use of process, have a process for project evaluation and selection, ensure proper management of projects, and provide regular reporting to lenders on the environmental impacts of these green projects. Details of the criteria are shown on the slide. For example, for components, the use of process. It is stated that the utilization of the loan process must be for dedicated green projects, and from the perspective of borrowers, they must consider which of their projects aligns with the green loan principles. So how can we define if a project is green? Green project refers to project activities financed with proceeds from the issuance of green finance to make a positive impact on the environment. You might also take a look at the right-hand side of this slide for examples. For instance, in terms of renewable energy, the installation of solar panels on a company's rooftop might be considered as a green project. There are also a variety of categories in addition to renewable energy, such as green buildings and sustainable water and wastewater management. While sustainable finance is no longer a new concept to the banking industry, especially in Hong Kong, there are some common questions that we see from our clients. For example, if only a tranche of a loan is green, is the whole loan deemed green? The answer is no, as only the portion that are used towards dedicated green projects can be classified as green. In terms of the application for green financing, some might wonder if there's any excluded sector for green financing. And yes, green financing does not extend to sectors including nuclear power generation, weapons, alcohol, gambling, and adult entertainment. Updated IFC exclusion list shall also be followed. Except for excluded sectors above, it is encouraged to promote and explore green financing with customers from various sectors. For the green projects, there's no geographical restrictions in principle. At Hang Seng, we have been supporting our clients to raise funding in Hong Kong to support their CapEx needs in mainland China or even overseas. And in the case of the violation of green provisions, or if it is concluded the facility no longer complies with green loan principles, the facility shall be declassified as green loan immediately. Both lender and borrower shall cease disclosing such facility as green loan in all publications of marketing materials. A point to note is that this will not trigger an event of default, and the client may still utilize the loan without the green label. I will now move on to sustainability-linked loans. In simple terms, sustainability-linked loans are any types of loan instruments that incentivize the borrower's achievements when sustainability performance objectives are met. The sustainability-linked loan principle sets out a framework enabling all market participants to clearly understand the characteristics of a sustainability-linked loan, based around the following 5 core components: selections of key performance indicators, calibration of these sustainability performance targets, the SPTs, loan characteristics, reporting, and verification. Details of each component are shown on the slide. For example, for the calibration of SPTs, there are actually requirements on how we define a legitimate SPT, in which a SPT should be ambitious and represent a material improvement to the borrower's core business. These SPTs should also be compared to a benchmark or an external reference, such as industry averages, be consistent with the borrower's overall and long-term sustainability strategy, and be determined on a predefined timeline, which are set before or concurrently with the origination of the loan. From the perspective of a borrower, they should ensure suitable benchmarks are in place based on historical performance and external peer comparison. And more importantly, seek external second-party opinion on the appropriateness of SPTs. Just now, we talked about the selection of key performance indicators. So what exactly is a KPI? With the increasing popularity of sustainability-linked loans, KPIs are designed to encourage borrowers to achieve their environmental, social, and governance ESG targets. KPIs are therefore critical to the effectiveness and integrity of the sustainability-linked loans to which they relate. Take the environmental component as an example. There are a few categories of the component that a sustainability can be related to, such as energy efficiency, greenhouse gas emissions, and renewable energy. For energy efficiency, examples might include improvements in the energy efficiency rating of buildings and on machinery owned or leased by the borrower. You can also take a look at the categories of other ESG components on the slide, like increasing training hours for employees under social and improvements in expertise of individuals sitting on the borrower's governance committees under governance. Moving on to the FAQ section relating to sustainability-linked loan, the first question I would like to address is, in view of the requirements for SPTs, can borrowers certify their own performance for SLLs? And it actually depends. Self-certification is permitted provided that the information related to SPTs is made publicly available or accompanied by an audit or assurance statement. Secondly, the eligible reviewers for syndicated and bilateral transactions under Hang Seng Bank's SLL program. For bilateral SLLs, HKQAA and recognized external reviewers under the HKMA Green and Sustainable Finance Grant Scheme are acceptable. For syndicated or club sustainability linked loans, the external certifier will be jointly assessed and agreed by all participating banks on a case-by-case basis. As for the quantity of ESG targets to be included, it is recommended to have at least two aspects. Let's say environmental and social to be included in the loan. In case the borrower fails to meet SLL provisions similar to green loans, this will not trigger event of default, and the loan will only be declassified as SLL. Just now, I mentioned about the eligible reviewers for syndicated and bilateral transaction under our SLL program. Some of you might be curious about the cost to obtain external review or opinion. The cost actually depends on the complexity of the loan structure and number of sustainability performance targets set. In view of the increasing popularity of sustainable financing, the HKMA has launched the Green and Sustainable Finance Grant Scheme in May 2021 to provide financial support to eligible green and sustainable loan by reimbursing review expenses to eligible green and sustainable loans. Eligible criteria include the involvement of a recognized external reviewer by HKMA, and the loan must be issued in Hong Kong with loan size of at least Hong Kong dollar 200 million equivalent, and the grant amount is capped at Hong Kong dollar 800,000 per loan. By the way, the Big Four accounting firms are all recognized external reviewers under HKMA's Green and finance grant scheme. And my team is more than happy to review your relevant teams after this seminar to discuss and explore collaboration opportunities in this regard. After introducing the two products offered by Hang Seng Bank, some of you might wonder, what are the distinct differences between a green loan and a sustainability-linked loan? The table here is an introduction of the major differences between a green loan and a sustainability-linked loan. One major difference is that for SLLs, there are no restrictions on the use of loan process, but green loans may only be used towards dedicated green projects. Secondly, borrowers and lenders will agree on specific targets to be achieved during the SLL loan life and not required for green loans. Also, SLLs incorporates margin adjustment mechanism to incentivize borrowers who are able to achieve their predetermined targets, while there are usually no such mechanism for green loans. After the introduction of the two kinds of loans, we will explore further the sustainability finance offerings and procedures of Hang Seng Bank. In the context of bilateral loans, there are three main programs that Hang Seng Bank offers. The first one is the Greenest Assessment Program, which is a bilateral program established between our bank and the HKQAA. The program is designed for corporate customers who would like to obtain bilateral loans for financing or refinancing green projects exclusively with HKQAA's third-party opinion. Corporate green framework is assessed to be in accordance with the green loan principles. The second one is the Sustainability-Linked Loan Assessment Program, newly launched in September 2021, and also a bilateral program between our bank and HKQAA, and designed in line with the Sustainability-Linked Loan principles. The third is the Green Building Financing Program. The program will be launched soon in early this year, in the coming months, in which the program is designed in accordance with the green loan principles and targeting green projects that have obtained the highest two-level grading from recognized green building certifiers, such as LEED, LEED, and BIM+. In terms of the first two assessment programs in the previous slides, as I just mentioned, the Greenest and SLL assessment programs are bilateral programs co-developed between Hang Seng Bank and HKQAA. A specialized and simplified Greenest and SLL assessment checklist report is designed for clients' application purpose. Some of the advantages of choosing our assessment include guidance provided by our bank and HKQAA on green framework and SLL framework setting. Shorter turnaround time comparing to the certification schemes, lower assessment costs compared to the green and sustainability finance certification scheme. The programs are also eligible under HKMA's Green and Sustainability Finance Grant Scheme if the loan amounts are over Hong Kong dollar 200 million. There is also a standardized template for annual reporting, so the application process is easier for first-time green loan applicants. Here are the application process highlights of our assessment programs. At the beginning, clients will discuss with our bank their sustainability goals and financing needs and determine whether they should apply for green loans or sustainability-linked loan. Our dedicated green and sustainable finance specialists will then provide advice on loan structuring according to the client's need and business. The term and conditions with green and sustainability-linked loan related clauses will be provided for companies' consideration. Borrowers will also communicate simultaneously with HKQAA or other external certifiers on framework preparation. Moving on, Hang Seng Bank and HKQAA or other external certifiers will proceed the application and internal approval. At the stage of documentation and drawdown, borrowers will need to obtain HKQAA's or other external certifiers' opinion as one of the conditions precedent before drawdown. Lastly, In terms of annual reporting, the compliance certificate signed by the borrower's directors shall be provided to our bank at least annually. External review report shall also be provided on an annual basis for SLLs. Now, after a brief introduction of these three products, let me share with you some of the real case that we have recently closed so that you can have a more solid understanding of these products. The first case is an externally certified green syndicated loan verified by HKQAA to a joint venture formed by two Chinese real estate developers. In this case, the key green element of the project is that it is a green building. The purpose of the loan is to refinance a residential project which has obtained provisional BEAM Plus Gold rating. Hence, this fulfills the requirement on project evaluation and selection as an eligible green project was identified. In terms of the monitoring of process, internal register is to be maintained on use of process. For the principle of reporting, any reporting to all lenders on loan process allocations, project energy consumption, and water consumptions are provided. Updates on final BEAM Plus rating was also required by the lenders. For the key documents of the loan pre-drawdown, the provisional BEAM Plus Gold rating certificate, project budgeting, and green finance framework and external review report by HKQAA were required. For the post-drawdown period, the borrower was required to submit the green finance report on environmental impacts to lenders annually, and also the final BEAM Plus rating certificate. Talking about the certificate needed for verifying a green building project, there are various common building assessment tools that are highly recognized in Hong Kong, including BEAM Plus, LEED, and China Green Building Label. These certificates give an important insight to lenders and external reviewers on how green the product is, and therefore it is exceptionally important if you are using green buildings as a key green element of your application. The next case that I would like to share with you is a bilateral green loan that our bank supported a pharmaceutical manufacturer in Hong Kong to install solar panels on their manufacturing sites. The borrower has also applied for CLP feed-in tariff program, which CLP would buy renewable energy from the market. This is no doubt a by default green project, so the eligible project is identified easily. Furthermore, the client was required to open a dedicated green account so that the green loan process can be easily managed and monitored. Lastly, the client was required to report to our bank the loan process, allocation, and environmental impact of the project on an annual basis to ensure the green element remains unchanged throughout the loan life. This marks the end of my presentation. I hope that you find it insightful and useful. To conclude, our green and sustainable finance team are continuously striving to enhance our product offerings as well as to expand our partner list. I welcome all of you, whether you are accountants or consultants for deal opportunities, or from the corporate side seeking green and sustainable financing, to reach out to me or my team at any time to discuss. Let's work together to make our planet a greener and more sustainable place. Thank you.
Thank you, Frank. Thank you so much for sharing your insights in terms of how to promote ESG from your bank perspective. It's very interesting to learn the new sustainability linked loan. It's very interesting, and I really appreciate your help promote ESG in Hong Kong and for all of us. So next, I'm going to invite Professor Alan Cho, Professor of Practice at Hong Kong PolyU, to moderate the panel discussion and the Q&A sections. So Professor Cho.
Thank you, Professor Wu. So thank you, Frank, thank you, Angela, and thank you, Dr. Wang's presentation today. So for those who haven't finished the survey, can you please help us to finish this housekeeping task? And then it will take you only a few seconds. Okay. So just a second, I think some more incoming questions. Okay. So first of all, for your kind support, and let us move to the panel discussion. So the first question I'd like to have is for Dr. Wang. So Dr. Wang, thanks for your sharing. And thanks for your sharing of the research results, which is really inspiring. So can you tell us more about the risk? Like what are the potential risks for banks when lending money to borrowers with higher carbon emissions?
Okay. Okay. Can you hear me?
Yes.
Okay. Okay. Thanks for your question. I think you are asking the risk, right? The risk for banks when they are lending money to borrowers, right? Or with higher emissions. Yes. Okay. I got it. So overall, I believe there are two types of risk the banks might have if they lend money to high carbon emission borrowers. First risk I would think is a kind of credit risk. So as I already showed some results, so if the borrower has higher carbon emission, they are more likely to have some additional or unpredicted regulations. So they have to spend more money on some compliance cost and even face some potential reputation loss or even litigation cost, eventually might hurt or increase the company's operational cost and lead lower profitability. For example, the high carbon emission borrowers are more likely to face more environmental scrutiny from regulator. So if the borrower violate any environmental laws, so they have to pay more penalties or fines. Clearly, this will hurt the company's profitability, even also hurt the company's reputation. So all those things eventually will lead a higher credit risk. Eventually, will hurt the borrower's ability to repay the principal and interest. So that's the first risk of the banks. The second risk is also from the regulator's perspective. So nowadays, more and more countries kind of are enforcing the lenders' environmental legal liability. So for example, Brazil 2010 started to launch lender environmental liability as kind of the tool to manage the environmental impact. In other words, if the banks borrow or lend money to some environmental damager, like some unfriendly environmental borrowers, not only the borrower is responsible for the environmental damage, but also banks, but also creditors. They have to also share the legal liabilities with the borrower. So the regulation risk might be the second risk the company, the lenders might face, because the lenders can be legally liable for some environmental damage it possibly caused by the project they finance. So overall, my answer for you is the risk of potentially be credit risk and regulation risk.
Thank you very much, Dr. Wang. So I have another question, if you don't mind. So I would like to ask, what role can banks play in the carbon emission reduction?
Okay, banks can play in the carbon emission reduction. Okay, I get it. So I think there are kind of two different roles the banks can play. So for some common loans or for some non-green loans, I think the banks can make those loans relatively more expensive, because if banks as the last table of my results, my paper shows, if bank push higher pressure on companies with larger carbon emissions through the tightened lending terms, the borrowers might consider lower their emission level, okay, in order to get more cheaper or more friendly loan deals from banks. Okay, so even for some very high carbon emission borrowers, I think banks even can consider to decline their loan application. So we did see some anecdotal evidence in US. More and more banks are inclined to not to lend money to the coal company, to the coal firm. That was very true during the Obama administration period. But of course, we did see some pushbacks during Trump administration. But in the long run, I believe the society is more and more likely to accept the trend to cut the loan for the high carbon emission companies. Okay, so that is so-called myself call that kind of passive way. Another is a proactive way for the banks to play their role. For example, as Frank also mentioned, maybe banks can think about to issue more green loans, because a lot of borrowers, when they are kind of cutting their carbon emissions, they do need money. They do need investment on some clean tech or any other infrastructure to reduce their carbon emissions. They do need money. So banks can play very proactive way to provide fund or finance their investment, to actively support the company's efforts to shift from very high level carbon emission to the low level carbon emission. Okay, that's in short, I believe maybe kind of make a loan more expensive for the high carbon emission borrowers, and issue more green loans to to encourage company to engage more.
Yeah. Okay, thank you, Dr. Wang. So it's very inspiring, very informative.
Or lower carbon.
Hello?
Yes, we can hear.
Okay. So, okay, you finished because a little bit choppy.
Okay, I'm done.
Okay, thank you, Dr. Wang. So very informative, very inspiring suggestion to the bands. So maybe Frank and Angela can consider and discuss internally afterwards with your team and see whether this is some areas that can help to play in the carbon emission reduction. So coming up, I have a few questions for Angela. So hi, Angela, you have shared with us what is climate risk management and how to manage this. So what are the key challenges faced by the banks in developing effective climate risk management capabilities?
Thank you, Alan. So maybe I will highlight one challenge, whereby in a lot of public seminars that I attended and the polling. One challenge is data. So in this seminar, we have been sharing the different perspectives about, okay, what would be the impact on high carbon emission companies? Can we obtain a better deal in a lending with if my company can have a transition plan, etc. Throughout last year, where we did the work on scenario analysis, our observation is that let's only talk about the carbon emissions. When we talk about scope 1, scope 2, and maybe scope 3 as well. So the extent and the consistency in the carbon emissions, reported carbon emissions data availability across the corporate companies in the market are quite varied. So on those big listed companies, they are regulated by the listing rules and the disclosures requirements. So often we can find slightly more information, even though I must say that I have read, I think, more than 100 these types of TCFD disclosures, carbon emission disclosures. The level of details disclosed is quite different. So, and the consistency, let's say, for example, this company considers carbon dioxide as greenhouse gas. Another company may consider a slightly more, let's say they include carbon dioxide plus methane plus some other gases as greenhouse gas. Or the business line, geography of emissions that they report could also different. So I think one challenge we see across many banks is that when we make use of these data, we, of course, ideally, we hope to have a consistent and complete picture of the carbon emissions. So, and this challenge is still happening, I must say. So what we're doing is that we are also working closely with accounting bodies locally and also regionally to try to participate in discussions about how can we improve collectively on the future, on the ongoing carbon emissions reporting standards, the accounting standards establishment, so that at an industry level, we can see and we can get access to these data in a more consistent manner. So it will be good for banks when we do risk management, when we explore the financing opportunities with customers. From the customer's perspective, it will be also be good so that it can help you to facilitate your discussions with your bankers. So data points is one area that we think it requires quite a lot of effort to improve.
Right. Thanks, Angela, for your information, for your answers to the question. So how about, is there any, or are there any good practices and read across from geographies outside of Hong Kong to tackle climate risk in the financial industry?
Maybe let me try to answer this question, and feel free to chip in if Frank or the colleagues here. So one example that I'm seeing is that from Europe, what we call the TCFD initiatives to standardize the type of carbon disclosures, reporting, and also the level of best practice sharing across the banks and the AIs. So I think this good practice is happening in Europe, and the pace that they are working on is even faster than is more advanced for a few years compared with Asia as by large. So from a supervisor perspective, what we're seeing is that in Europe, banks in general, they need to do a comply or explained starting from this year, because their regulation, they have given a few years time for banks to trial and beef up the capability of climate risk management. And so there are quite a lot of good disclosures, I must say. Standard Chartered, Citibank, HSBC, NatWest, there are quite a few banks, and also NGFS and the IPCC, they have published quite very good papers on promoting consistent practices in scenario analysis in how to incorporate climate risk into the risk measurement. So this risk measurement can be taken into account when banks evaluate the credits from our customers. So all these are good practices. Coming back to the Asia region, one important market movement is that we see that in our mainland China start to charge carbon taxes. By now, if you know, it's roughly around $8 US dollars per tons of carbon emissions, and is creating a market of carbon exchange, so as to promote basically the trading market, market transparency of carbon emissions. For heavy emitters, this will become a channel for them to buy carbon credits. For companies who work really hard to reduce their carbon emissions, this could be a market for them to sell their surplus carbon credits. So it's kind of becoming a transactions and open market to encourage more open and consistent information flows. So these are the good things that are happening in the market very fast. I think even in the Hong Kong, coming back to the Hong Kong areas, we, from our bank, we were also establishing a carbon impact exchange platform to support these carbon market activities. So from a risk management perspective, we are also like leveraging on the good practices worldwide.
Thank you, Angela. Since this seminar is organized by Polytechnic University, so I would like to ask a question on behalf of our students. So, what can students do to better equip themselves with climate-related knowledge to catch the future or existing job opportunities?
Sure. My 20 cents of inputs. Just to share a personal experience. First of all, there are increasing number of job openings that relate to climate risk analysis, from risk management perspective, from business. And so I would encourage students, if you're interested in this area, equip yourself with, there are a lot of industry readings. And if you are interested in getting a certification to kind of show that your dedication and interest, I have also taken the GAP, the GARP, the Global Association of Risk Professional, the examination on SCR, the Sustainability and Climate Risk. So to kind of to have a certification to show that you qualified on this area of knowledge. But bear in mind, because this industry, I would say, is evolving quite fast. So we need to read a lot and keep abreast with the news and development. And also, maybe I would take this chance to say, if any one of the students are interested, I do have some like entry-level openings. You can contact myself in separate.
Sure. That's a very good idea. Thank you, Angela. So now I think I have a question for Frank. Okay, Frank. Can you hear Frank?
Yes, you hear me? Yes.
Yes, sure. First of all, thank you very much for telling us about the future opportunities for the green and sustainable financing. So how about the challenges? So what are the challenges when structuring the green and sustainable linked loans?
Let's answer the question by the loan type. Okay, for green loans, is the verification of green elements in the green projects. Hang Seng Bank will get as much information on green projects from borrowers for our own due diligence. Afterwards, this is where the importance of external verifiers comes to play. We require a third party to review and comment on the green elements of these projects by having direct conversation with the borrowers. external verifiers would also confirm that the loan is structured in accordance with the green loan principles. Management of green process and reporting are also important. To ensure the green loan process are used solely for dedicated green projects only. We request borrowers to have a dedicated green loan accounts so that we can keep track of the fund flows. We also require borrowers to provide a compliance certificate to us to confirm the allocation of funds and the environmental impact of these projects on an annual basis. For SLL, sustainability linked loan, the insufficient or lack of information from client on the historical ESG performance. We have received increasing inquiries from our clients on SLLs, but when it comes to target setting discussions, the lack of sufficient information on clients' ESG data would be a major obstacle on target setting. We encourage corporates to start measuring their ESG performance earlier if they are interested in doing SLLs, which is also useful for their business growth. We also kind of lack of information for benchmarking. The average performance for particular industries. We understand that the Hong Kong Stock Exchange is enhancing their disclosure requirements for listed companies, which will lead to a more transparent market for all stakeholders. Furthermore, we also work closely with green professionals such as HKQA and CIC, the Construction Industry Council, as some of them have in-house data and experience on the particular sectors or industries. And then SPTs sometimes are not ambitious enough. SPTs have to be relevant and material to the borrower's overall business. And the targets have to be ambitious. There is always a discussion process between borrowers and lenders on the appropriate level, a level that borrowers are confident to achieve and acceptable by the lenders. Furthermore, during the life of SLL, we also request borrowers to have an external verifier to verify their actual performance on an annual basis. So that's my answer. Thank you.
Thank you, Frank. So I think that's all for my questions for the speakers. So the next section will be the Q&A session. And actually, we have received a few questions from the floor. So maybe the first question, I think Professor Wu would like to have this question first, right? For Dr. Wong.
Thank you so much for giving me the opportunity to ask questions. Basically, I have one academic question and one industrial question to Frank. So for Dr. Wang, so we know that you use the carbon emission disclosure to capture the climate risk, and you know that there's a differences between voluntary disclosure and mandatory disclosure. Basically, the data is from some NGO. So they ask companies to report their carbon emission to the NGO. So if I suppose I am a very heavy polluted company, so I know that the market might penalize me if I deliver the information to the market, because there is no mandatory requirement to disclose it. Okay, so for me, I have no incentive to provide this kind of information to the market or to the NGO to make it publicly available. So in this case, I guess that there is a selection issue. If I'm really heavily polluted and I know that the capital market will penalize me, why should I disclose such kind of information to the market to let the market penalize me? That's my question to you. My second question is to Frank. It's very interesting to hear the new sustainability linked loan, which is something something new to me. I haven't heard about that. I know that green finance is very common. So could you kind of introduce what's the major benefits of this kind of loan? Why the borrowers are interested in apply? What's kind of the favorable terms of the sustainability loan compared to other green finance loan or normal loans? Thank you.
Okay, all right, and maybe I can first answer Professor Wu's first question. Okay, so I think Professor Wu's first question about the kind of selection in academic term, we call that selection bias, because if everyone believe the carbon emission is a kind of bad thing, why company voluntarily provide those kind of information to CDP? First, I would like to highlight the character, the feature of CDP. CDP is actually on behalf of a very large institutional investor. So when CDP conducted the service, they on behalf of the institutional investor. I just mentioned a few numbers. To 2017, CDP is on behalf of around 650 institutional investors with 87 trillions in assets under management. So first thing is many academic people also talk about this. They believe CDP kind of a powerful institution. So when CDP survey the questions to the listed company usually honestly answer those questions. So that's the first point. The second point is actually in our one of the robustness check, we try to control the disclosure choice in our regression model, and we find the results are generally similar. So that's my, but we definitely cannot fully rule out the selection bias in the results, but we tried some ways to mitigate those concerns.
Thank you for your answer. Thank you.
So, Professor Wu, let me assume this that your company in question is willing to do SLL, okay, due to various reasons, due to regulatory requirement, or due to the fact that they need to do something on the ESG report to report something like that. So the incentives, of course, on the one hand, is just mentioned is they have to answer to the investors. The second point, from the lender's perspective, of course we are kind of mandate or we are encouraged to encourage our clients to do SLL under the ESG perspective. So the incentive, one major incentive is that we will consider from the origination or from the discussion of the loan, there will be margin concessions on an annual review basis. Say, for instance, you set a target day one, and then in a year's time, you're supposed to achieve that. Then the lenders will give, say, for example, 2 or 3 bips of margin reduction to to the borrower. And this can be a term loan, so you can have another 2 or 3 bips after 2 years time, something like that.
Okay. So another question, related question, you mentioned that a KPI for the sustainability linked loan, you look at the ESG, maybe 2 of them, ES. So
as many as possible.
Yes. Okay, that's good. That's good. That's my point. Is among the ESG, I think you will give more weight to E, right? Environmental is more like more major concern for you, from bank's perspective.
Not necessarily. We encourage clients to try to achieve as many targets as possible. But of course, there is also cost consideration, right? As I've presented. So, but anyway, it seems to us that the market is more sensitive to environmental issues.
Right. That's
true. So maybe a easier way to kind of to kickstart the discussion purpose with the clients, easier to grasp. For instance, for socials, maybe you talk about the gender equality, that kind of things, then I'm not sure if the society has a good concept, a good grasp of the concept of that already. I don't know. Maybe the professionals do, but I mean the general publics or the SMEs may not be able to grasp it, have a good idea. Environmental is a easier way to do. I must say.
It's easier to quantify. Yeah. So sorry to ask you last question. Is there's some puzzle for our academic research? I would like to get like insights from you, from you, how you think this issue is. That think about ESG for companies. Why they do ESG? So their motivation, is that really they are socially responsible, they do that, or is because they want to window dress to get the better loan contract, as you give like a sustainability linked loan, which is a better term. So I'm going to window dress, do something to this, and then satisfy the KPI, the requirement, and get the loan, get cheap loan. So is that because of this economic incentive, or because they really want to promote ESG? So from bank's perspective, is there any way to distinguish their true incentive? So I know it's a hard to figure out the real reason for doing this.
Yeah, you're correct, Professor Wu. But I must say, whether it's economical, or whether it's out of conscience, out of conscience, you have to do it, right? You have to do it. Our major concern is you do it right. You don't do greenwashing. You don't do SLL washing. You know what I mean?
But the issue is how you figure out whether they are greenwashing or not.
That's the reason why we have to do due diligence. Due diligence is important, and we also invite professional valuers or certifiers to really verify and certify the relevant projects.
Thank you. Sorry to take the time. Aaron, no, please go ahead.
Okay, so I got a few questions from the floor. So the first one is for Angela. So the question is, will you also be able to share some example how DBS applies this risk modeling for corporates or assets that you finance?
Okay, thank you, Alan. Maybe I'll just give one example whereby when we talk about transition risk, it's quite related to the other speakers that they're talking about. So when we make use of this bottom-up methodology, when under the scenario analysis, when we try to model and to quantify the, for example, the impact to the client's revenue, their capital expenditure, their debt burden, and the impact to their cost bottom line under the different scenarios, whether the government will introduce, let's say, $200 of carbon tax per tons, etc. Based on all this scenario analysis, we are using that to produce our kind of portfolio level risk quantification for stress testing, for collectively working with our regulators to assess the systemic risk in the banking industry. So this is one part. Second part is that based on these capability, I think Frank also touched upon a word about target setting. So these models will help us to inform the discussions with clients when we structure the loan, when we structure the deal, how or by what extent, by when can we support the clients to achieve the net zero target. So that is what we call target setting. By setting a targets from now until, let's say, 2030, 40, 50. So how can we support the client in the long term to move towards that goal? So it's a continuous monitoring, is a continuous third-party assurance, like what Frank mentioned, to to collectively actually would benefit both the bank, the client, and also the society at large to on these objectives. I hope I answered the question.
Okay, thank you. So actually, there's another question for you, Angela. So this is also related to the risk. So the question from the floor is, with regards to assigning risk level to a company or asset, do you utilize the quantitative data disclosed as per various metrics or indicators, and then assign a weightage? And if so, is there a mapping of technical standards that can be used to see if an indicator has been fully satisfied?
Okay, I try my best to understand this question.
It's a bit long, huh?
Just to take one step back, with regard to the risk measurement, like as I say, because of challenge of a very long time horizon, and the future is to a certain extent unpredictable. So actually there are quite a lot of different methods of that I'm aware of in the market to quantify it, so to speak, quantified the, let's say, the transition risk or physical risk to an asset. On the transition risk part, the common methods that we can use is, for example, bottom-up approach based on the carbon disclosures, carbon intensity that our customers report. Let's pick an example. Energy. So is energy production, power generation company. So by understanding their mix of energy production, fossil fuels versus solar energy, for example, and the historical trend, and their carbon emissions, and so we can project based on the NGFS and also some other international scenarios. Based on those scenarios, we can project the level of the impact to their cost, the impact to their revenue, the impact to their balance sheet and debt capacity in different periods of time, so as to assess their risk. I see some elaboration notes from the audience. Okay, so thank you for the example. So Rakesh provided us the example saying that if a company, they give us the compositions of their green product, let's say 30% from recycled plastic, and also or the carbon intensity, then is there a way to decide this company has a good performance or bad, and hence the risk and adjusted price? Okay, so in a way, we at least a method that we are adopting is what we call a bottom-up approach. There are some sectors in which we look at their carbon intensity. Those sectors which, for example, production manufacturers, we look at their carbon intensity trend over time, and then this analysis will be scenario specific. So based on, let's say, based on the disorderly scenario, if carbon tax increases to, let's say, $200 per tons of emissions by 2030, and assuming that the company, let's say, they will grow their recycled plastic productions in alignment with the market based on the NGFS projection of the demands, consumer demands, then we are able to project the revenues, the P&L of this company, and as a result, their profitability and also debt burden. Of course, there would be quite some assumptions behind. And so different banks or different institutions, they could have slightly different assumptions and sensitivity behind. And so as a result, we can work out their estimated rating, the estimated risk rating impact. And this risk rating could affect their credit the standing. So when we say whether the company has a good performance or not, then this rating, you can imagine this is something like a similar to external rating. if we project a company would have, let's say, 2 to 3 notch of rating, let's say downgrade in 10 years time under a certain scenario, then that piece of information can be used to facilitate the discussions in client engagement and the green financing as well. Whether we include that as a risk-adjusted price or not, that would quite depend on the exact situation and the client's financing plan. So cannot have a simple answer for that. But in the sharing, maybe Dr. Wang can provide some inputs. I believe that since this is something that we must do in terms of moving towards net zero, and so in a way, there would be incentives for companies to produce a good track record of carbon intensity reduction. And so as a result, hopefully this can also result in a better risk-adjusted price, providing then everything else the same. Okay.
Okay, thank you, Angela. Oops. Thank you, Angela. So there's another question from the floor. I think this is for Frank. So the question is, for the first time SLL issuer, will the overall all-in cost be lower? The SLL guidelines require ambitious SBTs. So can you please elaborate from the practical experience?
Yes, thanks for the question. So for the question mentioned about first-time issuer, I assume that there's no whatever framework of this from this kind at the outstart, right? So we have to start from scratch for this company. In that sense, actually our incentive is based on whether you can achieve the targets in a year's time. If you can achieve that, the incentive will be set 2 or 3 bips start, for example, margin reduction. Just an example, everything is subject to negotiation or discussion. The margin reduction, the incentive can be more, depending on the different clients. But I want to add one point is that if you are a repeater, or I mean, if you have already have this SLL framework, and actually you have done a lot over the past years, then this ambitious, quote unquote, we may have room to discuss. I mean, no need to be so stringent anymore, since you have done a lot of ambitious or achieved a lot of ambitious targets in the past years. So if you want to do another one, I mean, you are welcome to discuss with us. So can I answer the questions?
Yeah, I think so. And Frank, there's another question for you. So what is the loan spread saving for such green building project compared with the normal real estate loan?
It's quite common that the clients will expect the lenders to give out the concessions for green building. But I must say, if the client do a green building financing, I mean, of course, they will have this green building certificate already, right? Or they plan to get that. Upon the receipt of this green building certificate, actually, they got all the benefits they want, like they got better tenants, whatever, or investors, whatever. From the lender's perspective, I mean, we want to facilitate or we want to incentivize them. I mean, if they are willing to do better, of course, the margin reduction is negotiable, but I mean, don't expect too much from the lenders. Because from that perspective, since you want to do a green loan building, I mean, it reflects a lot on your company, your management quality, etc., etc. And that's actually improve and we hope to see an improvement in the credit quality of the client itself. And in that aspect, it's a risk and return thing. So if the credit we assess is better, of course, the pricing will be better. So it's not a definite answer, I know, but I mean, we are flexible and reasonable. Hope that answers your questions.
Okay, thank you, Frank. I think Dr. Wang, Angela, and Frank, thanks today for your presentation. I think that's all for today's Q&A. And I would like to pass the floor to Professor Wu for the closing remarks. Professor Wu, please.
Thank you so much. Thank you, Aaron. Thank you for moderating the panel discussion and the Q&A section. So time flies. I cannot believe it's almost to the end of our seminar. So for myself, I learned a lot of new insights from both my colleague and our industrial friends. So I would like to take this opportunity to thank all three speakers for their insightful thoughts on green financing and how to promote the ESG. So also thank Professor Aaron for moderating the section. So also thank our collaborating organization, HKIRA, and our supporting organization, Australia CPA and Hong Kong Institute of CPA. So last but not least, I would like to thank Carol. Without her, we cannot make this happen. She helped us to organize the seminar and then all the logistics. Thank you again. I believe it's a very wonderful and a successful event. So it's a very good start of the year. I would like to remind you, this is our first seminar for 2022. We will have 4 more seminars on ESG and sustainability related issues for our CSEF Center. So all of you are very welcome to join the other seminars throughout the year. And also, if you have any thoughts, or if you want to share your experience with us, you are welcome to reach us, and we will arrange that for you. Thank you so much. Finally, I wish you a happy, healthy, and productive 2022. So look forward to see you all again soon.